This is NDTV, and you're watching Classics.
Hello and welcome to The Big Fish on NDTV Profit. We're in conversation today with Mr. Aditya Puri, Managing Director of one of India's largest and best-known private sector banks, HDFC Bank. Mr. Puri, great to have you on the show. Thanks for joining us.
Thank you.
Let me first start by asking you, you've just completed a $1 billion fundraising. Tell us what the response was like and why you chose to do most of this in the international market.
The response was very heartening for two reasons. One was that India is really poised for growth. The investors are aware of it, and anything coming out of India today is really looked at very favorably. Two, we got a very good response from the investors themselves, some of the largest investors, that within the overall environment of India, they felt we were well positioned to take advantage of that environment and grow the bank. We raised $1 billion and we raised it at market price. There was no discount. It was oversubscribed 3 times. That was despite our telling the investors that please don't fluff your orders, just give us what you require, because otherwise allocation becomes difficult. And the response was good to the financial sector, to India's growth plans, to what is happening in terms of the plans of the government, and we are very satisfied with the offering.
In terms of the profile of the investors, what are they basically long-term investors that have come in? Are there any names you can give us in terms of investors that have picked up significant stakes?
I would prefer not to give the names of the investors, but most of the investors are long-term. I am basing this on the fact, one, on the discussions that I had with them. Secondly, if you come into a stock like HDFC Bank, which is fairly richly priced, you have to come with a long-term view of things, because otherwise the investment will not make sense and you will not be able to justify it. So by definition, when you're investing in a growth story, you have to have a long-term view of things, and HDFC Bank has never been a speculative stock.
Fair enough.
The investors that came in were some of the largest in the world, and a lot of them have been our investors for a long time.
Right. In terms of it from a shareholder's perspective, what sort of equity dilution are you looking at, and are you anticipating pressure on ROEs?
No, we are not anticipating pressure on ROEs. Let me put it to you differently. The fundraising was required to meet our growth plans. We have a return on equity between 19 and 20%. We have a dividend distribution of about 30%. That gives us net of dividend 15%. You add 50% tier 2. So our sustainable growth rate is somewhere between 21 and 22 based on our internal generations as well as leveraging it. We grow normally somewhere between 30 and 40%, for which we use up approximately 1.5% of capital a year. So this will take us, depending upon our growth rate, whether it's 30 or 40, between 2.5 and 3 years. Okay. We normally issue at around a 20% return on equity. And if we take 20 as sustainable and 30 as growth, we have a return on equity comes down to between 16 and 17% in the first year and goes back again to 20 when we are about ready to issue.
Right, right. Okay, now that the funds are in the bank, so to speak, tell me what your priorities are in terms of deploying this money. Is a lot of it going towards capital adequacy as you move towards Basel II?
The second question is easier. The other one will probably take slightly longer. Okay. No, absolutely not. As far as Basel II is concerned, if we had implemented Basel II as internationally recognized, we would probably have had some release of capital. The Reserve Bank at this point of time has imposed more stringent requirements than Basel II, primarily because it wanted to control the credit growth. So the risk weights are higher. Because of that, maybe about 7 to 10% of this money will be used temporarily to meet, because obviously as the macroeconomic conditions change, I'm sure RBI requirements will also converge with Basel II. So temporarily about 10% of this money is required for Basel II. Okay. The rest of it is required to fund our growth across multiple businesses that we are in.
Okay. And what businesses are you particularly looking at as growth avenues where you'd like to invest this money at this point?
Okay. We are in 3 main businesses: retail, wholesale and treasury. As far as retail is concerned, India is an underpenetrated market. We are well positioned in that market in terms of brand names, in terms of service, in terms of having our distribution capability. So we are expecting major growth in retail. We have not seen any slowdown in our retail growth. And we expect to see a 30-odd% growth in retail across multiple products.
Okay.
So both on the loan side, credit cards and deposits, we do expect and we are very confident of a good growth rate. And as we go deeper and deeper into the interiors of the country, we think the market will keep expanding. On the wholesale side, with the investment, the stage of the investment cycle, now is when the investments start, as well as people are gearing up with the higher production. And so we have found, as you would see in our first quarter results, uptick in wholesale demand as well. So we expect this also to grow at a healthy pace. In fact, here we expect better than what we had previously forecast. In addition, we've got a few new initiatives. It's like our agriculture initiative and our microfinance initiative. On agriculture, clearly, if you take the pyramid, at the bottom of the pyramid is microfinance. Microfinance includes the landless labor. By definition, microfinance, you create local viability at a village level or a district level. So it can't be scaled beyond a certain point. And the loans are normally through self-help groups or coordinated committees, and they range from 5,000 to 12,000. If it goes beyond 12,000, you're really in subprime and not microfinance. Here we've lent about 500 crores. We've helped 1 million families become self-sufficient. And we think we will take this up to about 2,000 crores in the next 24 to 30 months, which would, obviously, if at 500 we've helped 1 million, you take it to 3,000, you help 6 million, plus the hangover effect that you have. This is something that is important to management. We think it's something good. And we do believe that it's more important to create sustainability at this level rather than give out grants, because then he comes back to beg again. Exactly. This business is growing substantially. This is at the bottom of the pyramid. Next is the farmer who needs a pre-crop loan. And then when his crop is there, he needs liquidity as well as price discovery. Here we've got the Kisan Gold Card, which gives him a pre-crop loan, plus gives him 30% for his personal expenses. And then we have now developed, to a great extent, the warehouse receipt, which gives him liquidity. And then he can cover on the commodity exchange so that he can get price discovery. We've got a product for the money lenders, where we feel that if we lend to them at a reasonable price, they will reduce the price lending to the ultimate farmer, which is also doing well. But 40% of our branches today are outside the metro and semi-metros. They are in the semi-urban or underbanked areas.
Okay.
And through these branches, we are taking our retail products also to this segment. Okay. And we've also launched what we call a hub and spoke. So the branch acts as a hub, and around 50 kilometers, we have our feet on street going and selling products to the farmers at almost the same rate as we sell them in the towns. This is working well. We also tied up with business correspondents so that the farmer in the villages can go to maybe a cooperative bank's branch or one of our business correspondents and deposit and withdraw money. This initiative, we think, over the next 3 to 5 years will ultimately result in about 30% of the bank's business.
Let me just get this straight. In terms of your rural model, you're following both sides. You are looking at branch expansion to try and increase branches in semi-urban rural areas, but you're also tying up with corporates who are in direct touch with rural areas. Did you say 30% of your business coming from rural?
In 2-3 years of time, define rural as this. You see, the other point is that people, the last part of the business, which is also growing, which we call small business banking, is that people must understand that rural is not just farmers. Yes. When prosperity and commerce trickles down, then in that 20%, which is really called agriculture, there is allied activities to agriculture, which we are lending as business banking. And those are the small dry cleaning shops that are coming up. It's the garages, and this business is growing at 50%. So our strategy is 1, specific products for the farmers, 2, specific products for the ancillaries that will come up to service these farmers. 3 is all our consumer finance products into this entire geography.
Okay. What about international banking? I mean, there are a lot of banks that are gung-ho about international banking, both from the perspective of the retail consumer, but also the corporate consumer, with more and more M&A happening, more and more international expansion happening.
Now,
what do you think of that?
As far as international banking is concerned, there are 2-3 parts that we have to be clear on. And these are our views, which are different. One, naturally, we want to follow the NRIs. And some of the NRIs have Indian links, other want global products. And this is a business that we've been growing for the last 3 years. We want to grow this further. And this is one segment very definitely that's involved. The second segment that's involved is intermediating in short-term trade. And we've got permissions from the Reserve Bank to open branches overseas as well as rep offices. Okay. The third part where you say, are you going to become a major international bank? There we want to tread carefully because most people who've gone international actually have had difficulty. So whether you take Bank of America or you take Deutsche Bank or you take Barclays or you take NatWest, all of them have expanded and then pulled back. Long time back, I think it was somebody from one of these American banks who said 95% of my profit and only 5% of my problems are based at home. 95% of my problems and 5% of my profits come from overseas. Second is we also have to understand when we go away from our home turf, then you lose the advantages that you have in terms of a better product, better understanding, better brand name, and you're really competing against the large boys. You may want to, but it is difficult. You neither have the funding capability. The only real capability that you have is a reduced cost of processing. Whether that is sufficient enough for you to create a major impact overseas is debatable. Lastly, when we are getting very good growth in an economy that everybody is dying to come into, I'd rather focus my main attention to grow in India, which is needs greater penetration of banking, gives me good spreads, is a market that I know, and go overseas only to the extent that India globalizes. And yes, there have been some manufacturers that have gone, but at this point in time, it's not a flood or large enough for you to create a viable customer base across multiple countries.
Fair enough. You did say you had got permission from the RBI to go into some countries. What countries are you looking at, say, over the next?
Yeah, we're looking at countries in the Middle East, Far East, Europe, and Africa.
We'll take a quick break here on The Big Fish. We'll be back. We're talking to Aditya Puri, MD of HDFC Bank.